Are we about to see another bank fail? First it was Silicon Valley, then it was Credit Suisse, now will it be DB? Hello ladies and gentlemen, and welcome back to the Daily Show where we talk about stocks, commodities and cryptos. We need to do a deep discussion today of what's going on with the CDs of this bank because it's blowing out big time. At the same point, liquidity is returning back into the systems. Let's get into it right now. Well, welcome back everyone to the Daily Show where we talk about the macro news, lead indicators, and of course the hottest charts. They're all coming your way, including the S&P 500 and Nasdaq a little bit later on. But let's begin with Nasdaq 100 versus S&P 500. One of the best turnarounds that we've seen in quite some time. In fact, it's the best performing week for the Nasdaq as a combo compared to 2008. Now, often these are the types of periods that actually bottom markets off. So we'll be talking about that today. But more importantly, I want to bring to your attention why this is most likely happening. It has to do with the Fed's balance sheet. A lot of people are making a big deal about this, and rightfully so. When we've seen the Fed's asset prices kind of go back up and they start basically not tapering, even though they're claiming they're tapering, then we tend to see things like growth stocks do well. Now, since QE's really been introduced back in the early 2000s, this kind of held true, but specifically this was the interesting one. Now, when we saw an injection back in 2008, a lot of people are drawing parallels between these 2 points. Banking crisis. What actually happened after this injection was a watershed moment on stock markets. That's when stock markets totally freaked out about the financial system and what's going on. Now, each time is different, so I think that's important to state. But have a look at this particular chart here, and it's for DB, Deutsche Bank. Credit default swaps are blowing out big time. We're back to where we were basically during the pandemic and during other crisis periods for this bank. And it's similar to the Credit Suisse style scenario of the other day. Now, this is recently, this is a brand new breakout. And why this is interesting is because we've been tracking Fed liquidity by the day here. And what I've been updating you on is whether it's been upping or downing. The last 24 hours, we saw another injection from the Fed. And basically central banks around the world injected again. Now, why would they be doing that? Could it be that they're concerned about these credit default swaps and they see another domino falling down? Well, I would say that that's probably likely. We know where there's one, there's many. There's never just one. It's like anything. If you think about China right now with the property crisis that they've had, of course, there's some high profile names, but you just have to know there are plenty of issues behind there, hence why the stimulus is so real right now in that country. So we go over here and we start to say, okay, well, what is the new expectation of the market? Why did tech hold up better than anything else over the last 24 hours? Well, I think it has to do with the expectations. Yesterday, we were 50-50 in terms of whether we were going to halt and pause and the Fed was going to pivot, or of course, they were going to raise 25 basis points. Now economists are switching to it's time to pivot. It's time to pause. And in May, they do not expect a 25 basis points overall in terms of rate hikes. Now, if the Fed want to fight inflation, and remember, the only time they've been able to stop inflation once it gets past 5% has been to push the federal funds rate above the core CPI line. Now, if they can't do that, it's unlikely they're going to be able to stop inflation. So this is going to be an interesting fight between the Federal Reserve on the back door pushing in liquidity while keeping interest rates high, while also trying to combat inflation and a potential banking crisis on their hands that's becoming systemic. So we'll look more at DB in a minute on the charts, but I want to talk about smart money versus dumb money. We saw during the recent pullback, smart money went in hard, and it's pretty clear that smart money went in hard on tech. That was because they saw the inflows and they went with the Federal Reserve. That would most likely be the best example here for the smart money versus dumb money chart. Now, they've recently clipped a little bit that at these highs, and I think that's important to note. So with all of this going on, we can say, are we going to get a US recession? Well, the bonds market says yes. 50% of all yields around the world are continuously inverted at this point, And we're seeing, of course, a pivot by the Fed, which we know is theoretically negative in the future. But I wanted to just quickly do a bit of a kind of piece here on whether we've seen the bottom based on staples, utilities, and healthcare. So they tend to do very well during the last 3 months of a bear market. And you could make an argument, I just want to make this argument here, that we may have seen the low in October based on this alone. If you take a look at here, here's utilities, here's staples, and healthcare is just holding, that's this little line here, above most of the others. Now, of course, energy was out due to inflation, but it's interesting that over the period of kind of like July, August, September, the best performing were those sectors. Then since October, which is the low, we've seen in general some of the other sectors start to perform a bit better. If we took a date here and we said, okay, what's tech done? What's semiconductors done? What's all of those markets done from that point? You would have to say they've outperformed. That is traditional with a bottom. And if we see too many more breakouts, such as the Qs that we'll look at later on, we might have to consider that at some point. And certainly, of course, stocks like Nvidia look like they're already recovering. But don't worry, we have more on that later, because Kramer just said that he loves Nvidia, and we all know that's the kiss of death for stocks at this stage. So why am I so focused on both concepts? Because we are in a kangaroo style market. You can make arguments for a lot of things. The Fed is backdooring liquidity. The Fed is basically at the same time raising rates to combat inflation. So it's like a mixed message, and that causes problems in the market. But what I've always thought is that small cap companies, zombies, so many small cap companies actually don't make any money, are the ones that we need to be watching. So we need to watch the US 2000 and specifically look at some of the data points coming out from that. So small caps versus large cap ratios after cycles from 200-day high to low. We're at these points right now, and the results that I mentioned in the previous video are starting to get a little bit weird. Like, as in we're going towards, I would say, a neutrally kangaroo-y, not very good period of time for markets. Now, S&P 500 has fared okay in these circumstances, but again, it's been very lackluster a lot of the time, specifically the 1960s and 70s, and some would say, and parallels we could put with the 1970s. So again, kangaroo markets could continue. We also know that the Fed is most likely going to pivot. We have the bonds market proof to go with this, which we'll bring up on the charts very, very soon. But I just wanted to point this chart out that's been going around a lot on the internet at the moment, which is, of course, the previous pivot periods and what's happened when the Fed has broken the system. Now, we know the Fed broke the system. Otherwise, we wouldn't see every bank under the sun having issues. But whenever they've done this pivot, whenever they've actually pivoted from having a hiking cycle to a new decline, they don't do it out of the goodness of their heart. They do it because they broke something. And these are some of the previous periods, and you can see what happens with the Fed pivots and where the market goes. Now, you could say this time is different, but I wouldn't bet against this type of concept either, because the bonds market is reaffirming that we should be going into a recession. And we know that we are currently on the path around here, which is a no recession path. So if the market now starts to say, oh, there's a recession, remember the Fed's not saying that. The Fed will never say it anyway, even if there is one. But they've said, no recession, don't worry, guys, all good. Everything's all good, everything's fine. But if there is a recession, the general path for US equities would be to make a new low. So we have to be nimble and fast in markets right now and open to both sides. I know that's frustrating, but you have to be open to both sides. ERP went zero. I mention this all the time. Again, I believe earnings is actually going to be the catalyst for most of these market moves. There could be black swans, but generally it's going to be earnings. And we know that also equity risk is not being considered at this stage. That's a Morgan Stanley, Mike Wilson kind of concept we've brought up several times. Here are some of the major pivots that have occurred in the past. So we know also that basically the bonds market, this isn't the updated chart, but I just wanted to show you this. Basically, the bonds market is just saying cuts across the board. They say we need cuts, we need lots of cuts. The Fed dot plot, which I shared over on Twitter, showed us that the Fed themselves, if we go back over here, doesn't even know what they want to do. So we posted this, and over on our Twitter, we posted this dot plot, and you can see here they're confused themselves. There is literally a person I don't know who that is, but they believe that in 2025, we should have a rate of 5.5% for the US. I mean, who is this person? What is going on over here? I think it's funny because it kind of looks like an anchor that's being dropped out. See the down kind of arrows, and then it just kind of sits on the bottom of the ocean. So basically, we've got a declining dot plot, but nowhere near the speed of what we saw the bonds market claiming. So we're going to see, I would say, a fight between the Fed and the market moving forward. And this most likely will be one of the stories, along with earnings, that's going to become very, very interesting. And I think that we need to be paying attention to it. So just before we jump into the charts and we take a look at all of the key levels you need to be watching right now, I wanted to say a big thank you to the sponsor of today's video, which is Tiger Brokers. Now, in the description down below at the moment, there are a bunch of special offers for members of the FX Evolution community. And especially if you're from Australia and I believe New Zealand, there's a bunch of extra specials at the moment. I've managed to secure an extra US $30 worth of Tesla if you fund with as little as 1 cent. And of course, you also get the other bonuses that you would usually get with signing up the account. So what separates Tiger Brokers from many other applications out there? Well, it comes down to having the ability to customize the app to your needs, whether it's breaking news stories from premium resources such as Reuters, biggest hard-hitting kind of information that's come out over the last 24 hours, or customized watch lists to your specific country or watch list overall. It's all there in the platform. And I really like also that they've got a community of people sharing concepts. You can see the dot plot from the Fed here, and it's all there inside of the app. So if you're interested, why not check them out in the links down in the description below. So let's now jump into the charts, and we'll begin with the story of DB, because over here we saw a 6% decline in the last day. Obviously, it's been coming down pretty heavily, but it's another banking disaster. And what I mean by that is if you bring this up and you think about where this bank is and where it has been, this is the global financial crisis over here, 2007. You can see it went all the way to $20. It then saw a bounce, and now we're down, pushing into these lows. So I think it's worthwhile setting alerts for DB and seeing how the stock market's reacting to it. You know, say we get a new low under this price down here, which is $7.23. Could that be the market signaling, all right, here we go, this is about to hit the news, and potentially another sell-off in markets is about to occur? Certainly something to watch, and it probably shows you why central banks are starting to inject again, even in the last 24 hours. I think they're yo-yoing the market. They're trying to figure out how much do they need to put in to secure it, at the same time as they don't really want to show that you should go and buy or do any of those things because they're supporting it. It is a very bizarre market. Over here, we have the US 2-year versus the federal funds rate. We know that when the market decides that it's over, it generally is. And the US 2-year did that big time over the last 2 weeks. It went super negative. Basically, the 2-year dropped underneath the federal funds rate. And what that means is that we are most likely in the pivot. And I think we already know that, but this is just proof that the market believed it before we even got the FOMC this week. And it's another reason why, if you haven't subscribed to the channel, do so, because we share all of this great information on the daily here on these videos. So let's check out the US 10-year. Now, many people consider this to be run by the market themselves. That is, the Federal Reserve obviously controls the short date, US 3-month, and of course, US 2-year. Now, why would they control these? Because they're moving the interest rates on the short date. But the US 10-year is a long way away. So we know that it's all inverted, but what if the US 10-year breaks below 3.322? Well, that probably means something's very sick in the economy, because once we see this 10-year start floating away, and let's say it's floating away at a higher pace than the 2-year and the 3-month, it's saying that there is a significant sickness in the economy. And I do believe this is one of the key levels here. This is also going to be comboed with things like TLT, so treasuries. If we get through 3.322, then treasuries should theoretically make a new high and potentially show breakout. Let's look at the last 24 hours in markets. We saw high yield junk bonds drop. That's in line with the market. So again, we saw them drop. We're not at new lows. Again, setting alerts underneath the new lows will be one of the keys. I think if we see high yield junk go, and at the same time, we've got a market making new highs or breaching up or any of those things, very concerning. So we want to see high basically the market and junk come together with each other, be in harmony, not disagreement. And if they are in disagreement, I generally trust the bonds traders over the stock traders. Let's just say that. Now we move over to treasuries. Now, a lot of people in the comments section are making mention of this. They should be higher. This is a sickness. You've got to see this. Yeah, I think we do need to pay attention that treasuries are not where they should be. We really should be pushing 108 right now, considering 10-year. And then by 3.32, we really should be breaking out. So definitely treasuries are showing some signs of weird sickness here that they shouldn't show. And I think we need to keep paying attention to that. Treasuries should be at 108 right now, not 106, 105 something. And that is a major change over the last couple of weeks. Let's move over to the US dollar, which found some buying here. This was a nice bounce. We mentioned that we hit a super critical zone over the last 24 hours. And this comboed incredibly well with the stock market, which we'll look at later. The stock market was, I wouldn't call it trading perfection, but maybe it was pretty damn close. Let's move over to the DX. So the DX made a new lower low. We saw a swap. We saw a pullback to these areas, which was pretty nice. And now we've got a breakout. So I just say the dollar wants to try to test this previous support as resistance. This is going to be a form of, let's call it supply. So we know market placed sell positions there because otherwise they wouldn't have got such a massive break of structure. But effectively, pullbacks you would think are going to be met by buy demand at this stage on the dollar, which may mean, based on this dollar breakout, that we're going to hold yields for now. Now, this can all change, but the daily did show a nice 2-week day reversal, and that certainly is strong for a relief rally here in the dollar index. So it's rallying. I feel like it wants to go into this green box at this point based on the evidence that we've got at hand. Let's move over to gold. So it's doing its own thing. It's approaching that 2,000 again. It moved up, it moved down. You can see here on the weekly that we've got quite a lot of previous resistances at this zone. You would have to think that it tries to do some consolidation after having such a nice move out. But if yields drop, let's say the US 10-year gets through that low and 2-year starts falling off and all of those types of things, you have to expect gold to start to continue its skyrocketing powers. And at this stage, I would say gold is neutralized at this position. You know, I could make a case for bears, but they're going to have to really create a lot of structure. We'll get back onto that soon. Copper broke kind of out of this zone. Now, I've been pretty negative on copper. If we are going into an economic recovery led by basically central bank policies, then yeah, it could hold. I've been negative on copper for a bit. It's been working out well with obviously comboing into the minerals and metals and those types of things. But at this stage, we'd almost go neutral on it. I mean, I actually think it should be at 370, but that wasn't really the daily close that you want for that. So I would go with neutral. Some people will draw like a trend line through here. So maybe that's not the best one. Let's draw one together now. So you can see here, it's time for copper to fall right now if it's going to. And if it doesn't, well, we'll have to reassess the situation. We'll do so on our weekend video, so stay tuned for that. Natural gas continues to fall. It could still be in an accumulation range. We got that bounce off this zone here. Now I'm setting alerts just around this 2 to see a swipe of that. I want to know what happens here. And at this stage, we haven't had it down there. It's the Widowmaker. It's dangerous. Be careful out there, guys. Oil, yeah, that broke high. So you could actually make a case for short temporarily into long. That would be actually my scenario for oil at this stage. I don't know if it's super high probabilities. It's probably not for me. So I'm not really looking at it too much from that perspective. Dailies obviously look like a tweezer short. So that's, I guess, something important to state that at this stage, it looks like the rally, if there is one, should be met by sell demand, but I'd be very cautious around 67 as well. So oil's going to be susceptible to yields. Continue to watch that. Let's now get into our stock market analysis, though, and I'm very interested in some stocks here. Tesla is notable. It's on, well, it did touch a heavily traded zone. So we've got a massive trade zone here. We've got a 61.8 fib pocket that literally is from the low or the high to the low swing. We obviously know below there's 140, which I've thought we should be able to get to at some point in the future. Timing will be everything, though. We rallied off the lows that we thought. We moved here. I kind of suspected there might be some selling there. There was, but didn't hold. And now I think this is ultra critical. What happens at this point for Tesla is going to be important. If we get breakouts past, let's say, this point here, you have to think Tesla's going to start continuing to rocket. There are cases to be said that this is a inverse head and shoulders on the higher time frame, and that it could be looking at serious recovery. I wouldn't say that just yet, but certainly a heavily traded zone. Tesla needs to hold below 200 if the bears are to win. And this week, I would expect that to occur, because if we look at the options, you can see here, 200 is the most called area. Basically, the options are telling you, we don't want to go past 200. Why would we want to pay out these people? And they certainly don't. Now, Max Payne's at 190 this week, and we're trading like $3 above that. So again, they're doing a good job at manipulating options as much as they can. Apple, another day of weakness, another day of critical levels. And it's really critical. Now, Apple, I'm not going to focus too much on, because we know that if this starts making new lows, most likely the Nasdaq is as well, and they're all going to kind of drop in unison. It's not going to be a surprise. Nvidia got the kiss of death from Kramer today or yesterday. So basically, Kramer said, I like this stock now. And we know that's near usually kind of highs. I mean, this thing has moved over 100% up, and it's had some amazing bottoming. It's trading on AI, and I'm not ready to call it short yet. Obviously, I want to see the Nasdaq actually tell me something, which it hasn't fully yet told us that we want to go lower. But yeah, I would certainly watch a reaction up here. So if we got to 290, I'd say that's pushing it. And what I mean by that's pushing it is that would be putting in some big weeks. So these are not normal anymore. This week here is not a normal move, being 13, 14%. We've had not normal moves before. And let's just say when you have those types of moves, you're getting close to a parabolic market. And you can already see it feels like one. Over here, you'll get people saying it's in a bubble. That usually happens. But then now people just say, wow, it could go to the moon. Once that starts to occur, especially with such huge candles, you're usually getting near the end. But we have no signs yet that this thing is going down other than the kiss of death from Kramer. Let's move over consumer discretionary versus staples. What's that telling us? Nothing. It's sitting in the middle. It's showing us the American consumer is neutralized at this stage. And while there has been buying in tech, it seems to be that there's also, in general, a kind of confusion between how is the economy going to go in the future. Remember, this is discretionary versus staples. 1/3 of the US economy is the American consumer. So we have to be watching it. Market's not telling us enough just yet. The DAX is at critical zone. This is where the DAX must turn for the bears. The bulls just want to push a new high and then go into la la land. So that would be very good for the bulls. Critical level. And funnily enough, we're hitting a critical level while we have a potential credit default swap issue over in Europe. Let's look at the ASX. So the ASX market continues to suffer. We first reported on this a little while ago. So we knew that the Australian market would struggle in these times. It's made up of 3 sectors, the same as the FTSE really. Energy, materials, banks. They're not going to do so well right now. All of these are suffering due to the yield switching. So don't mark that the Australian market is the best place to be. It is a weak market at this stage. Even though I love it very much, I think it could even go lower. This is not going to be a good weekly close should it occur down here. It needs to hold above 6,900 bad. So I'd like to see it hold 6,900. If it can't do that through today's session, bad things could happen. It's at critical for the buyers. The buyers have to show commitment for this market to actually hold itself. Now we move over to the US market, and I think probably the most important chart that not enough people are talking about, US 2000, and all of the regional banks that are in here, but more importantly, the zombie companies. Now, if we see the market dumping these, we have to think, what does that mean? And the Russell 2000 can lead. And what I mean by that is it often can lead bad things. So we have here 1,700 as a critical level. If a daily closes underneath that, does that mean that the rest of the market's about to flip bad? I suspect that this is a very important chart for us to watch both ways. 1800 and 1700, this 100 points and the way it places and moves is going to be important. So watch the US 2000. We will be critically watching this over the next coming weeks. Let's move into the Nasdaq now. It held its own. You can see the rejection wicks here above the highs. The Nasdaq played the perfect game with the S&P. In fact, it was an excellent short and was a seriously excellent kind of position that people could have looked at over the last 24 hours. We know this is critical. And if we go back over to a weekly, you'll see that this is a very big Friday as well, because we've never really closed up here before. We found a lot of pricing in here, but we've never closed up here. The market kind of needs to sell off in the next 24 hours to show us that it really doesn't want to go higher. And the Nasdaq actually would need to wipe off to get back down to those lows around 1.3%. So where are we about to see another red day? Let's have a look at the Qs. Here's the Qs, long leg doji, high, low, open, close. This means indecision or equilibrium. It likes this zone. Makes sense. Of course, it's going to like that zone. It's the expected weekly options high zone. And also it's at critical. We can see that right now. SPX, another high, low, open, close. We rallied, we dumped. Perfect level there. It was really, really nice. So it filled the gap, did all of the things. It actually opened with a gap up. So that was the gap there. There where it was. Here it opens, rallied, came back. Beautiful gap fill. One of the scenarios we talked about in the previous video. Yeah, really, really, really nice. So the SPY or the SPX, here we go. There's the level again, high, low doji. We hit the very important zone, but let's move into the futures. So I've done some thinking about this, and yeah, there are a couple of things that I think could happen. Let's go through some scenarios of the next session. The first one is that it was a very strange close. And what I mean by that is we had some decent volume coming in, which you can see down here. And that decent volume pointed towards actually 39.30 zones maybe being bought during the Friday session. I'm going to watch the area. I think that area is worthwhile having on your charts and just seeing how it interacts with the smaller time frames and whether buyers actually show any commitment to it. If they slaughter that zone and push through and we get a new low, then of course we know it's basically a long leg doji. So once you breach, you're basically saying decision made, let's go down. Where are our major levels from that point? Well, I kind of feel like the big one is actually down here, being 38.66. This is now the major confluence zone. 38.66 is a big deal. So down here could be the next level. Now, if that all happens, the Qs will reject, the weekly will close on the low, which is big deal. The monthly's coming up very soon as well. That's going to be a huge closure for the Russell, for the S&P, and for the Qs, and for the Dow as well. And yeah, it's pretty important that the markets kind of sell here for the bears. So there's a scenario where this happens and we go back to 4,000 and then we kind of close there for the week. There's also the scenario where we melt this, move to a new low, and then next week, or even maybe if it's some cataclysmic Friday, we start selling off pretty big. But that's going to happen through probably some news event. Could it be DB? I don't know. It's possible. I think it's probably known, but as we know, things are in plain sight. Suddenly they become an issue and then the market cracks it. Let's refresh here the options. So let's have a look at the 24th and see how the market's doing. Well, it's doing pretty damn good because it's at the moment at 393. The max pain's at 395. And you can see there's quite a lot of puts in the system at the moment. So if it closed around here, it'd be pretty good by the market. I think it could close anywhere below 400 and anywhere kind of above 390 and be very happy with itself. So it's basically at critical. It's not a massive options week. So there's not anywhere near as much money as the other weeks, but that's certainly where it's at. If we move over to Bitcoin, it held the level. So nice. And we still kind of have to maintain that Bitcoin's going towards 30,200. So I could make cases for why it could sell off here, but I just felt like this is still the most critical zone for Bitcoin. And once it broke this critical area, it usually likes to move to the next level of equilibrium. And I feel like that's where it's at this stage. Of course, it's just Bitcoin, so it doesn't mean that it has to do it. But I believe that Bitcoin is probably reacting to, again, stimulus from the Fed, and more importantly, probably something to do with M2 money supply. So subscribe if you're interested, because we'll do some informational kind of, discussion about that and what our thoughts are here for Bitcoin moving forward. Do I think that sellers sit in this area? I would say yes, I think that they do, or potentially they are there. Again, technicals will lead the way. The way that it sets up through there is going to be very, very important. For the news ahead, we don't have too much. We've, of course, got here the prelim UOM consumer. Oh, not that one. We'll go forward here, sorry. I mean the flash services PMI, 945 New York. Please be aware that we also have daylight savings time shifts for a bunch of you out there in the community. So most of the Eurozone's going through that. And then for the week, next week, we've got consumer confidence, we've got unemployment claims, and then we go into core PCE price index. So it's not a massive week of news next week. It's going to be allowed to really play with what's going on right now in the markets. If you haven't already subscribed, then consider doing so. And of course, follow us in the links down below. And do remember today's sponsor of the video, which is Tiger Brokers. You can look at their description as well. And if you're interested in checking out the platform, what have you got to lose? Bunch of special offers. And all you need to do is sign up and fund with as little as 1 cent. So thanks very much for watching. Thanks for subscribing. And thanks for all of your support. See you in the next one. Bye for now.